Dear investor, the Indian stock market had a difficult year in 2025 and was among the relatively weaker performing markets. However, the Indian market seems to be turning around slowly. We have seen some improvement in our position across certain global performance tables. The Indian rupee has depreciated. The INR has depreciated quite sharply in the past period. The depreciation of INR may support margins of Indian companies. Export-oriented businesses make extra margins as Indian costs get lower in USD. Moreover, with most items priced in USD on a landed cost basis, currency depreciation may increase the attractiveness of domestic businesses. Imported items may become more expensive, potentially reducing demand and leading to more balanced global trade. Moreover, the INR depreciation has supported predominantly Indian value addition businesses like cotton textiles and shrimps. While our exports are seeing an additional levy of 25% versus the world, we have seen an INR depreciation of 17% from the beginning of the year. With low inflation in India and in combination with some price increases in the US, Indian businesses are able to mostly continue to function, albeit at a lower margin. Depreciation of currency causes markets to retract initially as foreigners try to preserve USD value of their investments, but over time it may contribute to improved market sentiment. Turkey and Pakistan have seen weak currencies but have seen strong stock markets. We have witnessed sharp FPI outflows in the past. As the currency stabilizes at new level, flows could improve gradually. Activity of foreign portfolio investors appears to be improving. The year 2025 saw sustained FPI outflows. However, relative valuations have adjusted and the currency is stabilizing at new levels. Additionally, the cost of capital is falling in the West and FPI activity has been less negative and we have seen a few consecutive days of buying. Domestic investment flows may improve if market sentiment improves. Indian domestic flows into MFs have remained positive but have averaged below the peak seen during last September to January period. This has happened even though economy has grown and inflation remains low. While one factor has increased investment into precious metals, we sense lower equity investments on account of poor performance of equities. We believe market construct is very light and low market volumes point to the same. Investors could come back strongly as sentiment improves and markets get a direction. Supply of paper in the market may have its peaks and troughs. Supply of paper in the Indian market has been strong. We are witnessing some of the largest fundraising as a percentage of market cap in our markets. This trend may continue. However, fundraising intensity is likely to have its peaks and troughs. We believe that the next peak is a few months away. With good outcomes for investors in past large issues, there is a chance of the market doing relatively better in the interim. The economy is managing higher US tariffs. While a deal with the US remains elusive, India is using the crisis period to its advantage by pursuing FTAs and preferential trade agreements with EU, UK finalizing, Canada, EFTA, South Africa, Eurasia, Israel, Mercosur, and a deal with Mexico to counter recent tariff hikes, while strengthening ties with Oman, new FTA, and exploring deals with Peru, Japan, Russia, and blocs like SACU, which include South Africa, to potentially boost global trade outreach. While it is still early days, Indian exports seem to be holding up well, supported by spaces which, as yet, don't attract US duties, such as electronics. Shrimps have found alternative markets. This may suggest that, in the event of a trade deal with the US, as India potentially reclaims its traditional markets, exports may see a jump. GDP growth seemed to be holding up quite well too. Q2 FY 2026, July to September, GDP was 8.2%, driven by services and manufacturing, leading forecasters like ADB and RBI to raise FY 26 growth projections to over 7% for the whole year. Crude oil prices are down. Crude oil prices are continuing to be weak. in spite of sanctions on Russia and Iran and blockade on Venezuelan crude. There are reports of a lot of Russian crude floating off coast of China in oil tankers for want of takers. If a truce in Russia-Ukraine war emerges, crude prices could remain weak. Lower crude prices may support the Indian economy. A $1 drop in oil prices saves the country roughly 1.3 billion. Season of quarter 3 reserves is around the corner. The quarter 2 reserve season was strong and better than expected, despite being impacted by long monsoons and purchase deferments due to GST cuts. The effects of strong monsoon and GST cut may be reflected in quarter 3. Most companies had indicated strong demand outlook during their result calls, which could support positive Q3 outcomes. Moreover, while the impact of US rupees has been the focus, the impact of currency depreciation may have a favorable effect on margins. The Reserve Bank has already cut rates and has indicated the possibility of more rate cuts. In its last policy, the RBI has cut repo rate by 25 basis points. Given the continued comfort on inflation front and rates cuts by Western central banks, there may be further cuts in the future. Rate cuts over time could reduce the cost of capital, potentially providing a tailwind for growth investing. Market valuations have improved over the past year. With the market being in a range and earnings having seen an expansion, there has been a valuation correction. Large cap earnings have grown at around 10%, resulting in a valuation correction of that order. However, the fast earnings growth spaces had a challenging year and may have seen over 30% correction in valuation. Not only have valuations improved based on earnings, but they have also improved vis-a-vis other markets on a relative basis also. Our markets have underperformed while most other global markets have been buoyant, and versus large markets like China and the US, our valuation correction could be around 35%. Sentiment may improve if a fair US trade deal is reached. While the direct impact of US duties has been manageable, it has affected investing sentiment. US is a significant allocator of flows globally, and absence of deals may mean that India is a less favored nation, potentially impacting investing sentiment. A positive deal, if it happens, may change that, and money on the sidelines may come in, possibly induced by strengthening INR. This could set in motion a favorable cycle of flows, potentially supporting the secondary market strength. FPI flows aiding forex reserves, allowing RBI, which in turn may further support sentiment and flows from the domestics. Let us explain how our portfolios are positioned and why. Our portfolios have representation from all of the growth spaces in the economy, including defense, renewables, EVs, capital markets, electronics, new tech, fast growing spaces in tech services, and lenders. The export orientation of our portfolios is limited to about 15% in most constructs. Banks had a good run in the past period but now face the headwind due to potential rate cuts. Our portfolios have limited exposure to banks but have a reasonable allocation to NBFCs. In our investing history, we have witnessed strong outcomes in certain periods. For example, in the 1990s, the software space emerged. It started small but grew for several years. In a similar way, new private sector banks came in the early 2000s. This was followed by construction and real estate during the 2004 to 2007 period. Between 2008 and 2020, the focus shifted to consumer businesses, life sciences, and select pharmaceutical companies, as well as premium bikes and select NBFCs. The common thread across all these phases was simple business models combined with sustained growth over many years. During this long period, India pledged gold in the early 1990s. The technology bubble bursted in the early 2000s, the 9/11 attacks of 2001. There was also the attack on the Indian Parliament in December 2001. The global financial crisis followed with the collapse of Lehman Brothers in September 2008. Later that year, Mumbai faced the 26/11 attack, COVID-19 from 2020. The US Federal Reserve pumped large amounts of liquidity and later tapering it. Oil prices rose above 110 US dollars in 2022. Japan raised interest rates between 2006 and 2010, then reduced them and has recently increased them again. More recently, there have been conflicts involving Russia and Ukraine, Israel and Hamas, and tensions between India and Pakistan. While all these events affected equity markets, history shows that over the long term markets have largely followed earnings growth. Our portfolios reflect these lessons. We have tried to improve representation from all the spaces where the combo of strong and sustained growth potential exists. In most cases have been with the top few players from the spaces with the thought that the leaders have already demonstrated the best fire in the belly, an attribute we want. Growth investing is high beta, and hence volatile and short-term returns can vary but may work well for a long-term investor. Historically, markets generally have followed earnings growth, and as lot of examples in the past period demonstrate, our constructs differ from the index and are in this manner risky. However, they are structured to participate in potential long-term earnings, growth opportunities. Putting all of this together, let us summarize our market outlook for calendar year 2026. Calendar 2025 has been tough for equity markets. However, every tough period can potentially increase the probability of a better next period. As we get into 2026, there is some hope. This hope stems from improved relative and absolute valuations, potentially improved money supply globally, and lower cost of capital if central banks cut rates. Positive developments in trade relations with EU, the US, and others given the importance of Indian market. Good earnings growth outlook on a low base from last fiscal. Lower crude prices, which could be helpful for the Indian economy. Improved investor sentiment, potentially leading to better FPIs, domestic flows, and resultant broader market participation. High growth spaces are sustaining relative outperformance in earnings growth. More growth areas like circular economy, data centers, etc. are emerging. Since we believe market follow earnings growth, we continue to believe that this is time for alpha. Thank you and happy investing. Wishing all a very happy new year. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.